LPA, Logical Price Action, the complete course. Session 9, bonus. This is an additional session, and here we will cover multiple time frames. Please take a read through the disclaimer and the copyright. Don't share on any file sharing sites or torrents, etc., and share with forums. So today's agenda, we are going to discuss multiple time frames. Multiple time frames is definitely an advanced aspect within our trading methodology. Although complex and complicated, it's well worth the effort and time to master this art, as it highly increases the odds of our setups. Trading with multiple time frames is an art. It's a highly skilled tool. Why? Well, as bars unfold on a 5-minute, a 10-minute or a 15-minute time frame, our lowest time frame, we're always thinking, how does this look like? What does this look like? How does this unfold on a higher time frame? So the way one thinks and approaches the market forever changes, because we're not just looking at the static chart in front of us. We're trying to think of all the possible scenarios on higher time frames as the bar is unfolding. Okay. Needless to say, Wyckoff didn't use multiple time frames as the technology way back then in the early 1900s. All the charts were drawn by hand. We don't have the use of a 5-minute or a 30-second or a 10-second bar that we can just change on our software, our trading software. He used P&F charts, point and figure charts, which is a skill in its own right. However, I supplement, or I should say not supplement, I've discounted point and figure charts and used multiple time frames. I don't use both. I've literally just mentioned that multiple time frames is an incredibly complex addition to the methodology that does provide an edge. However, it's advisable to learn sessions 1 to 8 in their entirety before this inclusion. Understand your setups, know them backwards, forwards, and everything in between. Make the setups that you use on a daily basis or weekly basis, finely tune them. Then come back to this bonus session here on multiple time frames, as this should open your eyes. This is an excellent introduction to the use of multiple time frames. I mean, perhaps in the future I may produce a separate course with various studies, many more studies, to include both intraday and swing trading time frames. Without further ado, let's begin. Multiple time frames can be used in a variety of ways. And once fully grasped and integrated into one's trading, it will literally open up the charts. And from a personal perspective, I like to think it takes trading to the 4th dimension. Spreads being the first, closes being the second, and volume being the third, and of course finally multiple time frames being the 4th dimension. How does it help? Well, when we can understand and use multiple time frames in alignment, so we have say a 5-minute, a half hour, or a 45-minute and an hour in the daily, and we can read the daily and the 60-minute, we can trade with the flow. Therefore, we're trading with the path of least resistance, which I'm sure many of you have heard previously. So multiple time frames, they can help with direction, and we will go through examples today. And we can also use our concepts and principles across different time frames to create either a story of strength or weakness. So we're getting mass confirmation, which of course, if we're confirming strength on a 5-minute time frame, and we're confirming strength on a 60-minute time frame, and on our daily time frame, we've just sprung, we've just closed via a spring, odds favour higher prices. Agreed? This is what I mean by mass confirmation. We are increasing our odds of success on our setups. We will go through studies today highlighting this incredible, powerful advantage of using multiple time frames. We can use higher time frames for structure to include yesterday's daily highs and lows. This is extremely important regardless of time frame used. Whether you trade a 30-second chart, a 5-minute bar, 15-minute, 45-minute, hourly, 240-minute bars, or daily. Daily highs and lows are extremely important as much trading occurs around these levels. The daily highs and lows we will classify as structure. This is incredibly important for intraday trading and also daily trading. There are still funds out there with very basic models that will sell stop the lows and buy stop the highs. Of course, it is contextually dependent and they know when to employ the strategy. We can gain additional insights into the market when looking into lower or higher timeframes. We can either disconfirm or confirm strength or weakness. This may appear complicated, but don't worry, we will go through all of these advantages of using multiple timeframes today, in depth, and hopefully from this introduction on multiple timeframes, things should click and you should be able to open up the charts for yourself. Good. Let's go on to our first study. Multiple timeframes, crude oil futures contract CL, one of my favorites, using a daily time frame as our higher time frame, and I believe it's a 60-minute chart we're using for our lower time frame. We can use multiple time frames in a way that may offer an insight on occasion for tomorrow's trading. This may differ from the higher time frame or indeed confirm our analysis that may appear a little sketchy by using our highest time frame alone. Let's look at oil for an example. So what can we note here? Well, we have an established downtrend. Don't forget that this is a daily time frame and we've been trending down for over a month, so we could say it is well established. And let's look at the bars. The first thing coming in, what can we note about bar 5? Well, bar 5 has a similar spread to the previous bar, yet volume has increased. And we know that to be effort versus result. So we may have a mild case of effort versus result on bar 5. And there is more subtleties at work here. If we look at bar 4 and 5, what can we see? Buying off the lows. So we close off the lows, so we know there is some buying at the lows. Now, if we use our comparative and relative analysis, this action at bar 4 and 5 is different. Why? Well, because we're not making as good progress to the downside. Look at this bar, widespread, closes weak. Widespread, closes weak. Widespread, closes weak. Then these two bars, we have fairly good spreads, but we're closing off the lows. The way price is moving down is different. Not only are we comparing the down bars, we are using our comparative tool at structure. At the supply line here, we come down. Here we come down. We touch here, we come down. We touch here and here. Yes, we come down, but again, we're not driving down, breaking structure like these bars. The bars 4 and 5 are making downside progress in a different manner. We are at the same location here and here at the supply line, and as we said, we're not closing weak. We don't have these wide spreads breaking structure. Okay, buying off the lows. From the daily alone, it's very hard to judge tomorrow's direction, and we would have to say that we would still expect lower prices because we are in a downtrend. However, we must note that bar 5 is a mild case of effort versus result, and we can see that from these two bars, as we try to drive down, we're not making the progress like we did on bars 1, 2 and 3. So now we're going to drill down to a smaller time frame, in this case the 60-minute chart. Let's see if it offers any additional insights. Now we have the past 5 days of our daily bars, and this is bar 5, more or less the close from bar 5 on our daily chart. So this bar 5 here is this bar 5 here. What can we see here? Well, we're in a downtrend. A solid 5 days adhering to a channel. And what can we note about this channel? Well, it's fairly good. We hold here, we hold, we hold. And we come up here, hold. And what is this area? It's a supply confluence. We have this level of support. We break over 50% of our spread, so it's valid. Yet we push back up. We test this level of resistance and the supply line and look at the negativity we see on this bar. We close weak. So if we're in front of the markets here and we see this print, we know that's a short opportunity, and this obviously would be our target, being the demand line. Back to our multiple time frame analysis, we react from here as we should. And as we come back down, we break structure, support. We have a nice wide spread with a pop in volume, closing weak. Yet we become a little vulnerable here. Why? Because we're close to being oversold in our channel. Now, bar B prints, and what can we say about bar B? Well, this is a bullish case of effort versus result. The spread is about a third or less than a third of the size of bar A, yet the volume is only a third smaller. This is not bag holding per se, but there is an incredible amount of buying in this bar. Now, importantly, ask yourself, so B is a bullish case of effort versus result. And where does this buying occur? At the demand line from a respected down channel. Interesting behavior from bar B. So then bar 5, there's no downside follow through, and then we drive up to close firm. No downside follow through after we have effort versus result at bar B. And what do we notice about bar 5? What's important about bar 5? Well, if we use our relative or our comparative tool, it's the largest buying bar we can see anywhere on this chart. After bullish versus result and structure holding. We dipped under on B, reversed to close, back above, trading within our channel. No downside follow through from 5. We have the widest spread up bar anywhere we can see for the past 5 days. This is significant. And also, there is no downside follow through from bar A, where we would naturally expect further prices to decline. For tomorrow's trading, from the 60-minute chart, we would want to be buyers. Can you see how the 60-minute chart here has opened up a fairly strong case of strength? Whereas the daily, not so apparent. But we have mentioned the potential demand coming in. You know, we're not coming down like we did here, here, and here at the same structural location being the supply line, and we can see buying off the lows with effort versus result. Although the daily is not so apparent, by dialing into the smaller time frame here, being the 60-minute, where we can see strength emerge here, we get a cleaner read. Just to be clear, we're not trading here, going through the setups. This study should hopefully get you thinking into how we think by using the multiple time frames. By drilling down to the lower time frame, i.e. here the 60-minute chart, we gain additional data. And this study alone is powerful. Why? Well, because we're going into the market wanting to be a buyer. This is an edge itself. Half the battle has been completed. It's nothing more complicated than trying to figure out if lower time frames are either confirming a higher time frame message of strength or weakness, or is revealing additional insights that create a conflict with our higher time frame analysis, as in they are not correlated. I mean, in this example, we had an idea of strength via the daily, and as we drilled down, we gained an insight of strength, confirming our suspicions. And this data gives us a license coming in for tomorrow's trading to be a buyer. Before we move on, I must say that higher the time frame, the more credence we give to its structure and direction, as we always want to trade in the direction of higher time frames. This would be trading with the flow, the path of least resistance. However, in trading, as we know, it's somewhat paradoxical. Turning points will inevitably make themselves present on the lower time frames first. And these make excellent trades, as we may catch a turning point for a new trend via our higher time frame. And of course, this is paradoxical, but trading with the higher time frame direction always increases the odds of our potential setups. We are trading with the flow. Good. I see no questions. On to the next study.